In today's video, we're going to be diving deep into everything you need to know about ISAs in the UK in 2025. Whether you're just starting out or you want a clearer understanding of your options, this guide will cover the different types of ISAs available, including cash ISAs, stocks and shares ISAs, lifetime ISAs, innovative finance ISAs, and junior ISAs. We'll break down how each one works, the contribution limits for this tax year, the key benefits and risks, and important rules you should be aware of. And by the end, you'll have a strong grasp of how these tax efficient accounts can fit into your overall financial plans and help you save or invest more effectively. But just before we dive in, this isn't financial advice. It's simply a general overview to show you the kind of options that exist right now, so you can make your own informed decisions. With that said, let's get into it. ISA stands for Individual Savings Account, a popular type of account available to UK residents. The main appeal of an ISA is that it allows you to save or invest money while sheltering the returns from income tax and capital gains tax. This means that any interest earned, dividends paid, or capital gains made inside the ISA are completely tax-free. Each tax year running from April the 6th to April the 5th, the following year, you have a maximum allowance you can contribute across all your ISAs. For the current 24 to 25 tax year, that allowance is set at £20,000, and this £20,000 is the total amount you can put into all types of ISAs combined during that tax year, not the overall balance of your account. So if you put £10,000 into a cash ISA, you can only add another £10,000 to your stocks and shares ISA or your lifetime ISA for the remainder of the year. Remember that this allowance is set by the government every year and can change. So it's important to check the current limits each tax year to make sure you're maximizing your tax efficient savings. A cash ISA is essentially a tax-free savings account. It works like a traditional savings account, but with one big advantage. The interest you earn is free from income tax. You can deposit up to your ISA allowance or part of it into a cash ISA during each tax year. There are several types of cash ISAs, including instant access accounts, fixed rate accounts, and regular savings accounts. Instant access cash ISAs let you withdraw your money anytime without penalty, making them a flexible option for emergency funds or short-term savings. Fixed rate cash ISAs lock your money away for a set period, typically 1 to 5 years, in exchange for a higher interest rate. Because cash ISAs are considered low risk and your capital is protected, they're often recommended for conservative savers or those with short-term goals who want some growth without risking loss. Keep in mind, interest rates on cash ISAs vary widely between providers and can fluctuate over time due to changes in the Bank of England base rate and economic conditions. So it's a good idea to shop around for the best rates each year. Stocks and shares ISAs give you the opportunity to invest your ISA allowance in a wide range of assets, including individual company shares, investment funds, government and corporate bonds, and exchange traded funds, ETFs. Unlike cash ISAs, the value of investments inside a stocks and shares ISA can go up or down with the market. This means your returns aren't guaranteed and you could get back less than you originally invested. However, over the long term, typically 5 years or more, these ISAs have the potential for higher growth than cash savings. Popular investment options include diversified investment funds, which spread risk across many assets, individual shares of companies, or bonds, which offer lower risk exposure and can typically provide predictable income through interest. In recent years, ESG investing has gained significant traction. Many stocks and share ISA providers now offer ESG-focused funds, allowing investors to support companies with strong ethical, environmental, or social responsibility records while still aiming for financial growth. This trend reflects growing investor demand for sustainable and responsible investment choices. Be aware that stocks and share ISAs typically come with fees. These can include platform fees for managing your account, fund management fees, and sometimes trading commission. These charges can reduce your overall return, so it's important to compare fee structures carefully. To open one, start by choosing an investment platform or provider that offer ISA accounts. Most platforms also offer tools and educational resources to help you understand your options and make more informed decisions. The Lifetime ISA is a special government-backed account designed to encourage saving for two main purposes: buying your first home or saving for retirement. You can contribute up to £4,000 per tax year into a Lifetime ISA, and these contributions count towards your overall £20,000 ISA allowance. The government adds a 25% bonus on your contributions. So for every £4,000 you save, you receive a £1,000 bonus annually. This can make a huge difference over an extended period of time. Individuals between the ages of 18 and 39 can open a Lifetime ISA with contributions allowed until the age of 50. There are two main scenarios where you can take money out of a Lifetime ISA without paying a penalty. First, if you're buying your first home, the property must be worth £450,000 or less and located anywhere in the UK. That limit is important, especially with rising house prices, because if the property's value is over £450,000, you won't be able to use your ISA funds without triggering a withdrawal charge. Second, if you're not using the money to buy a home, you can access it penalty-free from the age of 60. Before that age, if you withdraw for any other reason, you'll face a 25% penalty, which doesn't just take back the government bonus, it also eats into some of your own contributions. But once you hit 60, you can withdraw your full balance tax-free for any purpose, whether that's retirement, investing, or just spending, however you like. Innovative finance ISAs allow you to lend money directly to individuals or businesses through peer-to-peer lending platforms. You act as the lender, and in return, you earn interest tax-free on your loaned funds. IF ISAs can potentially offer higher returns than cash ISAs because they involve lending to borrowers who pay interest. However, they come with increased risk. Unlike cash or stocks and share ISAs, loans made with IF ISAs are not covered by the Financial Services Compensation Scheme. This means if borrowers default or the platform fails, you could lose some or all of your investment. Because this is a relatively new ISA product, long-term data is limited. So if considering an IF ISA, research the lending platform's reputation carefully and understand the risks fully before investing. Junior ISAs are tax-efficient accounts designed to help parents and guardians save for children under 18. There are two types: a cash junior ISA and a stocks and shares junior ISA. The total contribution limit for junior ISAs in the 24 to 25 tax year is £9,000, which is separate from the adult ISA allowance. Parents or guardians open and manage the account, but the money legally belongs to the child. At age 16, the child gains control of the account but cannot withdraw funds until they turn 18. An interesting point is that individuals aged 16 or 17 can hold both a junior ISA and an adult cash ISA, potentially allowing tax-free savings of up to £29,000 across accounts in one tax year. Junior ISAs can be a powerful way to build savings for future education costs, a first home deposit, or major expenses. Before you open or contribute to an ISA, it's important to understand the key rules and limitations that come with them. Here are some essential tips to keep in mind. Contribution limits. The £20,000 annual ISA allowance applies across all your ISA accounts combined. You cannot exceed this limit in a single tax year. Tax-free growth. Any interest, dividends, or capital gains you earn inside an ISA are free from income and capital gains tax, helping your savings and investments grow faster. Multiple ISAs. You can hold more than one type of ISA in the same tax year. For example, a cash ISA and a stocks and shares ISA, but your total contributions across all accounts cannot exceed the annual limit. ISA transfers. If you want to switch ISA providers, Use the official ISA transfer process to avoid losing your tax benefits. Simply withdrawing money and redepositing it counts as a new contribution, which uses part of your annual allowance. Unused allowance. Now, ISA allowances do not roll over. If you don't use your full allowance within the tax year, you lose it. So try to maximize your contributions annually if you can. As for eligibility, you must be a UK resident. Cash ISAs are available to those aged 16 and over, while stocks and shares, lifetime and innovative finance ISAs require you to be 18 or older. You should be staying updated. Remember, ISA rules and allowances can change each year, so always check official government resources for the most current information before making decisions. ISAs remain one of the most valuable tools for UK savers and investors seeking tax efficiency in 2025. Each ISA type offers unique features suited to different financial goals, risk tolerances, and time horizons. Cash ISAs provide safe, flexible savings. Stocks and shares ISAs offer long-term growth potential with investment options including growing ESG trends. Lifetime ISAs encourage first-time home ownership and retirement savings with a £450,000 property price limit to bear in mind. Innovative finance ISAs open the door to peer-to-peer lending, but come with higher risk and no FSCS protection. Junior ISAs help build a tax-free financial foundation for children's futures. Maximizing your ISA allowance each tax year and choosing the right products aligned with your goals can make a significant difference in your financial well-being over time. For detailed, personalized advice, always consult official government websites or seek guidance from qualified financial professionals. That's all for this video. Thank you very much for watching till the end. I appreciate it for being a subscriber, and I will see you again on the next one.